venture capital investment, VC money, equity investment, many different ways to say the same thing. Should you take it? Is it a good idea to take VC money? I would say no. Let's start with this point of view. Why would you not like to take VC money? Well, there's a long list of reasons why. First of all, if you're now being bootstrapping and there's no other external investors, you can do whatever the bleep you want to do. You are in control. And when you take someone else, you're not in control anymore. Even though you just give a tiny bit of the company away to that external investor, they usually make you to sign shareholders agreement and you sign off the rights to decide on those most important things. You have to get an agreement from the investor, and that's something you cannot take away unless you somehow get rid of the VC. And that's usually very expensive because you have to buy them out. That's one thing, and it's not a tiny thing. I think it's a very important point. And even just this one is a good reason enough to not take VC money. Because if you have a bit unconventional business, or you are really stubborn and hard-headed in a way that you know how to build your company, you want to build it in a certain way, and you don't really appreciate and like that somebody else is maybe changing the direction of the company, then VC money may not be your first preference. That's certainly a very important point, but there are others as well. One of them, and it's actually related to the previous one, it's a categorical thing. You have to consider what type of company you're building. If you just take one VC, just a tiny bit of money, you're already in that category. You lost the game. In that sense that you cannot undo the decision easily. And when you take VC money, their business model is that they take other people's money, they put it to work, and then they need to return that money with interest and profits, obviously. And there's only a limited amount of time to do that, which means that when you take that VC money, you can start to hear the clock going tick-tock, tick-tock. And no, that's not the funny cat videos type of video service. It's the other type of tick-tock. Tick-tock for your exit, tick-tock for your company to be sold. And that clock is not exactly, the timer is not exactly on your hands. Because the VC fund has the maturity of, well, it tends to be like 10 years, the life of the fund. But depending at what stage of the fund you're taking the money in, how long they already been in the market and allocating capital. If you're coming in the later stages, you don't have 10 years. You maybe have 5 years or even less. So you are in a hurry to build value to the company and do an exit. And if the market is going to the wrong direction, if there's something else happening, that it's going to be very difficult to do a proper exit in the timeline. Well, that's what you subscribe for. You're not in control anymore. And that's part of the package. So VC money is not free money. Then there's also the thing that you're losing quite a lot of the upside as well. And depending how much money you take, at what valuation and how many rounds you're doing, it can be a considerable amount. It can be even so much that when you're doing the exit, it doesn't really feel like that you're getting compensated for all the hard work, and it's worth the total effort, total amount of time you have been putting to the company. And in some cases, it is actually more advantageous for you as a founder to sell the company earlier on, because you have a higher ownership stake in the company. So you get more absolute dollars or euros or whatever the currency you are using than later stages when you have diluted so much that your proportional share is quite tiny, and it requires a huge exit valuation in order to match the previous one. These are reasons why serial entrepreneurs in some cases are not taking VC money. They want to take it the long way. They want to take it the slow way. They want to build a company how they see is fit. And in some cases, they don't even want to exit. It's not a lifestyle business per se, but they're not in a rush to do anything. They want to build a company and they want to be in the business and see where it takes them. And in that case, if you take VC money, it becomes quite complex and hard to accomplish both missions. Return the money for the investors and keep your company and keep you at helm of the company. So, should you take VC money? There's also the idea that more money you get, easier it will get. And that's certainly a temptation. If you've been bootstrapping, it sounds like a lot of fun to get more money, you get more resources, you can hire more people, so you don't need to do all the dirty dishes and swipe the floor of the office at night after everybody has left. So you can focus more, you can achieve more. And in certain cases, that's the right thing to do. But money can't buy love. Money can't buy you traction. Money can't buy you a lot of things. So if your core product or your core value proposition is not working, you can throw a lot of money and waste it and still have those things unsolved, because you just have more action happening, you have more people, you have more noise, more stuff around you, and maybe you also a bit distracted from the most important things, or it's easier to avoid those things, so the mistakes can be big as well. Then there's also related issue to the capital allocation. VCs want to have a certain stake in the company, and how they can increase their stake, they have to give you more money because that's what they're selling. And you, on the other hand, are always in the losing end from the dilution perspective. So consuming a lot of capital, expediting the market growth might happen at some time, but at some points and in some cases it can also be that it's not in the interest of the business or the founders to get more money than you can actually reasonably allocate and use in certain stages of the company. And that's something which you learn only after the fact, that you have given out too much equity and now the company is maybe a bit bigger, but you certainly are holding less equity in the company, and maybe the exit is not as lucrative as it could have been. Those were issues which are, I think, very important. Then there's also this issue that, do you get along with the VCs? You start to get more of them if you go that route. If you have a seed state investor in, then you probably have a Series A, and maybe you go to the Series B, And they are certainly different type of investors. They are probably coming from different countries, even continents, and the way they work may also differ. And then you start to have also conflicting interests. Not all the investors are also aligned. The early ones are more, the very early ones at least, are more aligned with you, the founder, because they may not have the capital to defend their position anymore in the later rounds of funding, so they are diluting as well. And the later stage investors, they have their own terms and ideas, how much they deserve and how much risk they're taking, and they might start to renegotiate what's already on the table and what's been agreed beforehand. And this gets messy. This takes bandwidth as well. So you start to have a management issues as well in regards to your investors. And there are also cases where things don't go that nicely. But let's not go that route too far. I think that was probably like 4 or 5 different reasons why you should not take VC money. Let's add one to the punch, and that's your type of business may not suit for the VC type of investment. Maybe you grow slower, or you don't need the capital, or it's a certainly different type of business in the sense that you do lifestyle business and you don't want to exit, you don't want to do those things. So just for the sake of taking money, you should not take VC money either. And well, maybe they are not even offering that to you. But there are cases where, and I know them personally as well, where the business is so lucrative, you're just making so much money that you don't need the VC money. Well, VCs would love to get into the business. They would love to get a stake in the business. But what's the value for you? Maybe you don't see any value. You have all the capital you need. You don't need that for the growth. You're already cash flow positive. So that's something to think about. And I think that's the really nice position to be. Best businesses probably grow with cash. They don't need external funding, external bosses to tell what to do. Tell what you think. Leave your comments, leave your experiences, share your experiences, and see you in the next video.